it's important to kind of ground yourself in why you think these things are happening together. Because I think that informs a bit of your view of like, well, is that going to persist? Is some of this going to unwind? Which side is going to unwind? I think it just gives you a bit of like tactical awareness of the space. I think a lot of people just passively kind of consume this data. And I think it's always important to kind of critically kind of assess why those things are happening together.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Larsen.
Welcome back to another conversation in our series of episodes that focuses on markets and investing from a global macro perspective. This is a series that I not only find incredibly interesting as well as intellectually challenging, but also very important given where we are in the global economy and geopolitical cycle. We want to dig deep into the minds of some of the most prominent experts to help us better understand what this new global macro-driven world may look like, and we want to explore their perspectives on a host of game-changing issues and hopefully dig out nuances in their work through meaningful conversations. So please enjoy today's episode, hosted by Harry Krishnan.
Thanks very much for the introduction, Niels. My guest today is Rory Johnston, founder of Commodity Context, a physical commodities research firm based in Toronto, Canada. It's a pleasure having you on the show, Rory.
Thanks so much for having me, Harry.
Can you please tell us a bit about your firm and how you came to start it and what your background might be?
Yeah, so prior to starting Commodity Context, which is, as you were noting, kind of an oil-focused research platform hosted on Substack at commoditycontext.com. Before that, I led commodity economic research at Scotiabank here in Toronto, which is one of the large Canadian banks, and by most metrics, the most heavily weighted towards resources, kind of Western Canadian energy, Latin American mining, et cetera. So I kind of had my education in the space there. I left at the beginning of 2020 to start a family, join a family office, kind of, take a slightly different tack. Then, pandemic
Wait, you started
hit.
a family and you joined a family office at the same time.
I did double family. And obviously at the beginning of that, as I was shifting kind of gears, COVID hit. Commodity markets, which had been on a bit of a grind downwards in various ways for the better part of a decade, and I think we're fairly depressing for a lot of people in the sector, went completely haywire. First, my phone started ringing off the hook from, old media contacts from my days at Scotia, like, why is oil negative? What the heck is going on? So I kind of got pulled back into the oil side after, very tentatively trying to leave for a hot second there. And yeah, so I kind of got pulled in and I kept researching and kind of reading and following the space so I didn't sound like a moron talking to my media contacts. And I was like, why don't I write it down? So I started writing it down. I'm like, why don't I publish this? And that's essentially how Commodity Context started in June of 2021. It went on for a year as a free publication just to kind of see, what interest in this space was. To my shock and amazement and gratitude, it was a decent uptick, decent pickup. And so last year, mid 2022, I turned on paid and kind of turned this into my full-time grind. Now Commodity Context has over 16,000 free subscribers, hundreds of paid subscribers. And generally the focus is I've got three main product verticals. I've got my kind of main bread and butter of thematic pieces. So usually once every 2 weeks, thematic deep dives on various things. The next one I'm working on is the air travel and jet fuel demand recovery. I've got monthly data reports called my data decks on global oil balances and then North American oil industry. And then every Friday at the end of business, I publish Oil Context Weekly, which is a kind of a weekend wrap up of what's happened in the market, what's kind of moved in the market, and kind of what's driving things, and gets people set up for kind of processing the week that just passed and then kind of getting started for Monday.
What do people use your research for? Are they PMs? Are they
generally,
analysts?
yeah, I think I'm quite happy that I have a reasonably broad swath of kind of like a fairly diverse group of people. I have, your PMs and your analysts in industry, obviously, like a bunch of institutional accounts. I've got a lot of personal. I think there's been a huge rise in kind of personal trading and family office trading in this period, particularly in oil and gas names. So I think that's been a huge kind of area. Also, policy analysts and kind of government kind of sector. That's actually, very frankly, where my background is before getting into, before starting to work at a bank. My background is global affairs, policy analysis, et cetera. So I really wanted to have a product that kind of could dig deep and kind of become interesting. It would be interesting to someone that's an expert in the sector, but also kind of communicate it in a way that doesn't alienate or scare off people who, it might be one of 10 things they cover. So my hope is to kind of give, and I really lead into the name of the publication. I think my goal isn't to, I'm not a fortune teller. I'm not going to pump a view really hard one way or the other. Exactly. If only. Right. But it's really, the focus really is on context and providing kind of a bit of whether it's like a bullshit detector or a bit of just a sniff test to some of the narratives that are bouncing around the market. Because I think right now there are many, many, many narratives that are bouncing around this oil market, and just trying to just add a little bit of concrete, like, there's plenty of stuff we don't know, but what do we know? And I think just kind of trying to ground us in some kind of, proper footings in this market.
Is it important to have access to what the big energy companies are doing to do your job, or can you do it purely on a data driven and geopolitical driven basis?
So I think all of this information is useful. I don't have regular conversations with like the CEOs of Exxon or Chevron, but a lot of that information is presented in their annual and quarterly reports. My focus isn't particularly equities, except for what they can tell you on a kind of a broader sector level about what's happening, let's say, to U.S. energy investment, or what's happening in the oil sands as a kind of a modular kind of sector level. So I think it's not essential. And I think, quite frankly, a lot of people over-fixate on publicly listed equities because that data is available in there. And I think a lot of the kind of industry data is messy, kind of awfully formatted, and difficult to kind of compare and contrast apples to apples. So that's really more my focus. And again, I come from more of a bank economics department view, and I worked with our FIC groups and our equity research, et cetera. But I left the kind of equity research to the equity research analysts, and I tried to add something a little broader to essentially the price assumptions that are going into these models.
And the clients who use your research, let's say the family offices, to pick one thing, do they focus more on trading equities and energy sensitive equities, or do they actually trade the futures directly?
To my knowledge, I think most of the people in this space are expressing their view on the commodity through the equities, just because they're the easiest, most liquid to kind of access. But that's my understanding. Yes.
Understood. And now I've tried a new type of show, and I tried it with Marko Papic some time ago, and it's basically to make a bunch of statements, partly to show that I'm no expert in the space, so people can correct me, but also just to say some things that probably aren't true, just to see what an expert like yourself might say. So the format I wanted to choose today, and I hope the viewers don't skewer me for this, it's definitely not Rory's fault. If it's anyone's, it's mine, is to make a few statements and then just have you respond. And I'll play the role of the straight guy, or whatever the phrase is, and we can have a little bit of a back and forth based on these points. Now, the first point sort of centers around the unpredictability, or the potential unpredictability of energy markets, and what you can actually use as sensible or reasonable data inputs to draw some conclusions about where prices may go. Of course, this is never written in stone. So let me start with point number one. Geopolitical analysis in the energy markets is basically useless because if something has happened, such as a war in Ukraine or a China lockdown, complete lockdown, that's already baked into the price somehow. And the future evolution of politics is inherently unpredictable. So there's no point even bothering about it. Can you respond to that one?
Yeah, I would say that, a lot of my focus, again, leaning on this context, keyword here is, I think the geopolitical analysis gives you a sense of kind of a parameterization of the possible. And I think while it's true that, let's say, once Russia invaded Ukraine, as I think the most clear and kind of present example of this in the last year, yeah, I think like if you had a really good bet on that prior, if you really thought that was going to happen, I think it gave you an edge. But I think to your point, like all of this is inherently kind of probabilistic. I think you mentioned that you kind of started this format with Marco, who actually has a really interesting framework around approaching geopolitical risk. And I think that is the important thing, is to have a framework, to have kind of a systematized approach to geopolitics. I actually came to the oil space from a geopolitical background. My background is actually not economics. I came from a policy analysis, a global affairs, and kind of a global security background. So I kind of came from this vantage of everything is geopolitics all the time. And I think as I've been kind of educated in the space, if anything, I think I've almost switched in that balance. And I think that the challenge, and I think the reason that geopolitics often gets a bad rap in this space is it's very easy to do bad, flippant geopolitical analysis because it doesn't lend itself naturally to kind of a framework that you can kind of, parameterize and track and kind of, iterate on. So I do think that like if you have a really good framework and you have a really good track record of approaching things in this way, again, like a Marco, I think that actually does give you an edge. Because like right now, like whether it's, Russia's invasion of Ukraine that we are now currently in, or Chinese kind of government COVID-0 policy, et cetera, I think having a sense or an idea of where that's going to go and a reason for it that you can kind of revisit and add new information to over time, I think gives you a big edge because these narratives fly so wildly week to week. And I think just being able to, just simply fade the noise sometimes because of a framework, I think gives you a lot of, not credit, I think like a grounding, I think, in reality.
So taking China as an example, again, I'm not the expert. You would set a base case, which would be a path of reopening or a speed of reopening, and then you take the data points as they come in and make adjustments to that. So you might be looking at air travel or any number of things, whatever the politicians are saying, interpreting that. And so is my understanding that if you set a path for the reopening process and you have a price level or a demand level associated with it, an incremental demand level, then you would adjust that over time as the data comes in. Is that the approach you're taking?
That's exactly right. And I think that for something like a kind of a Chinese reopening, I think a lot of what we've seen, and I think this is the other thing with geopolitical analysis broadly, is it doesn't always lend itself nicely to like base case forecasting. I think it lends itself to like scenario planning. And I think that if you have a couple different kind of core scenarios with a bunch of like very regimented kind of parameters to them, you can kind of tell over time which one you're trending towards. And I think that gives you a sense. So like, let's say, Chinese reopening is an example. Let's say, September of last year, there was a lot of debate about like, will China ever reopen? Is this going to be a permanent kind of, lockdown of the country? Is COVID-02 tied to the kind of legitimacy or perceived legitimacy of the Chinese Communist Party or Xi Jinping himself personally? There were a lot of, I found, and this is like my error, I did not think they were going to reopen as quickly as they did. I think that I read a lot of compelling analysis. And I think this is, again, where geopolitical and kind of political analysis can kind of lead one astray, that, the one of the best comps to COVID-0, a policy that for all intents and purposes from the outside looked insane, that was, completely bizarre in its kind of commitment to kind of keep that level in, particularly given the fact that, the latest variants were so much more contagious, but less deadly. And, all of these things, you saw, Chinese workers like spraying, disinfectant on roads and like just bizarre kind of theatrical stuff. But the comparison was to the one-child policy, where that policy stayed on the books for so long, so much longer after everyone knew it was, a ticking time bomb or unsustainable. And I found that compelling. That turned out to be wrong. And I think, there were other people that nailed the call. And I think that if you had a really good view of, what was going on and how the Chinese Politburo was discussing and handling these factors, I think it did provide you an edge in at least kind of fading some of the calls that, China would never reopen. I think there was always this kind of like, is it going to be a spring? Is it going to be a summer 2023 kind of situation? But I think that was more of the story. I expected there to be more. I expected it to be a more gradual process. I expected it to be, a couple months of gradual sentiment and communication that calms changes from Beijing. But it essentially there were protests. There was an upheaval, and then all of a sudden, like a week later, they were releasing these points for reopening, and then that seemed to just snowball from there. So I think that was an example of a call that I personally did not get right. But I think that some did. And I think that if you were a China expert, I think that provided you some kind of grounding and kind of at least kind of fading one side or the other of the extreme there.
So if I'm an energy money manager, if I'm investing in energy, is the following idea correct? I don't know what the fair value of oil is, let's say, but I do think that I have an out of consensus view on where supply or demand will come in, which will affect the price at the margin. So assuming that the price is reasonably fair now, and I have a different view that I got from Rory, from commodities context, I can use that as a way to lean on a long or short position simply based on the idea that that is a piece of information that isn't baked into the price that may lead to a directional move in my favor. Is that kind of the thinking?
Yeah, and I think that you'd compare that to whatever your proxy for consensus supply and demand outlook would be. So whether that's the IEA or the EIA or OPEC's monthly reports, that outlook for, let's say, 2023, which outlook do you kind of find yourself trending towards? Are we expecting to see deficits this year? Are we expecting to see surpluses? How does that balance? And I think even more importantly, what underpins those surplus or deficits? Is it I think what you see, I just recently did a piece that compared all the major outlooks from the major monthly forecasting agencies. And you can see that they have a lot of their assumptions are very similar. And I think that's important because you can say, like, okay, these are what I call kind of consensus or what I call agency consensus assumptions. U.S. production will grow, X barrels a year. Chinese demand will grow X barrels a year. OPEC will do this or whatever. But then you start to see like, oh, okay, their differences are in the extent of China's growth or the extent of non-Chinese Asian growth. And I think that is where you can start to really pick apart the supply demand balances. And then you can, I think that only at that point, I think, should you then begin to kind of layer on your own assumptions. Because I think otherwise, I think the challenge sometimes people are like, oh, okay, I think China's going to reopen and it's going to be big. Because of that, I'm really bullish. But a lot of the agencies or consensus already builds in kind of a big Chinese demand boost. So is your assumption bigger than that? Or smaller than that? Or is it just on par? Because if it's just on par, then you actually don't have like an against consensus view. You're actually like right in the middle. And I think it's just, again, I think my focus, and I focus a lot on supply and demand and kind of decomposing these balances. And I think it's important to know because, there are so many pieces to them, so many pieces to these global supply and demand balance models that it's very, very easy to get lost in some of that minutia and kind of lose, the forest from the trees. But I think it's important to know like which particular tree that you're disputing while trying to make this kind of overall macro call.
How are these production and demand forecasts made? What's the methodology? Is it just a simple regression or extrapolation, or is it based on surveys? Or what do these guys actually do?
So, it's mostly based on surveys. And that's what's interesting. So the challenge, I like to picture like data relevant to the market broken down into kind of three chunks. You've got, supply and demand balances, which are lagged, often by usually 2 to 3 months. I publish my global oil data deck, which was just published in January, and that covers November balances. So I think just to give you a sense,
I could argue that supply is probably stickier than demand. Is that correct?
Supply is, yeah. So, I mean, supply is usually easier to kind of peg down. I wouldn't always say stickier per se, because I think supply itself can be very volatile, but I think that you typically have a better sense of supply, and there are fewer revisions to supply after the fact, because generally there are far fewer producers of oil than there are consumers of oil, just, definitionally. So I think what you often find is, particularly non-OECD demand data often gets revised after the fact, even after it's initially kind of available, like let's say on a 2 or 3 month lag, you'll still see revisions to that after the fact. The reason I say, and I just to kind of finish this thought of like the 3 different chunks. So you've got these like lagged supply and demand balance numbers. I think the important thing to know here is like the other thing that people over-fixate on in this market is the weekly EIA numbers, the weekly petroleum status report published by the EIA. That's something that I think is really, really, really valuable for inventories. And I think really, really confusing and distracting for virtually all the rest of the data in the report. And the reason for that is that the actual data that like the actual accurate data that the EIA publishes is still published on that 2 to 3 month lag. Like today we are getting published data from the EIA from what they call the Petroleum Supply Monthly, which is the much more accurate monthly report. And that will cover November. But we still have weeklies, for supply, demand, imports, exports, refinery runs, et cetera, as of last week. But what you see is those weekly data are imperfect estimates of something that won't be actually kind of nailed down until months later, and will continue to be revised after the fact. And people just overfix it. And the other challenge with the weekly data is everyone just loves to throw a chart up and kind of show weekly data because it looks more impressive, it's higher frequency, it looks whatever.
More to sell.
Exactly. It's a great way to sell. I've particularly at the beginning of my career fell victim to this quite frequently. And what you realize is that the weekly data also isn't back revised, which is a huge challenge because you're compounding errors. And so a great example of this was this past summer, the weekly demand data, or what the EIA's weekly petroleum status report calls product supplied. It's essentially a measure of wholesale demand, essentially supply that disappears from the kind of observed and surveyed system. What that showed, or what it purported to show, was that demand in the summer of 2022 was lower than the demand in summer 2020, which just seemed nonsensical. And I think everyone was like, oh, this is the Biden administration, torturing the numbers to try and, talk down oil, et cetera. But no, what you realize when you look back at the numbers from summer 2020 was that the EIA, based on its methodology, was materially overestimating supply then, and that by the time you got to summer 2022, they were moderately underestimating demand. So you got this double compounded error that it was, demand in 2022 summer was likely slightly weaker than 2021, but nowhere near as weak as 2020. I think that's just one of those errors that I think people kind of ran with, and I saw like 100 stories written about this. And I think it just comes from a basic misappreciation for what the weekly data tells you and kind of what it doesn't.
So you kind of have a level of confidence in the various data releases that come out, and that informs your research.
Absolutely. And I think that just to kind of, and I keep getting distracted as I'm going through these 3 buckets, but so you've got like, it's good, I'm glad. The supply and demand data is lagged and is an estimate and will continue to be revised. And I think, so you've got the least kind of confidence in that set of the data. That said, it also, at least on its face, is the most comprehensive. Then you have inventory data. And that's where I think that the weekly data.
So hold on, comprehensive and wrong. Basically,
I think, but wrong in a useful way, and I think that's the important thing here. Is I think, and we'll talk in 1 second about why I think that is so useful. But let me just kind of get to these other 2 because I think they inform kind of how I handicap that monthly and kind of supply and demand data. Because the weekly data is much more accurate for the areas that we do have it. And I think that's where the weekly petroleum status report and the weekly US inventory numbers are very handy. That is, for the most part, survey data that is kind of accurate, and you will see that it doesn't deviate materially from the monthly releases, like slightly here and there, but materially, that's the story. And I think if you have a scenario where your supply and demand balances imply massive inventory builds, but you're seeing material draws in, observed inventories, then you probably know that your supply and demand estimates are probably off to a degree, or at least they might be. I think that's your first warning sign. The challenge with inventories is that while the US is, highly frequent with its entire inventory set nationally, the other high frequency weekly inventory data that we get from, let's say, ARA Europe, which is the kind of ports, major ports around, Amsterdam and Rotterdam, and the kind of the data from Singapore, it's a far, far smaller pool of oil that's being sampled. And you have much, much more unknowns. Like, as an example, one of the big trends of this past year has been considerable building of Chinese inventories of both crude and refined products. And we have zero publicly accessible data on Chinese inventories. So that is the challenge here, is that, it's more certain, but it's less comprehensive. And I think that is where, that's where I differ from the supply and demand data. And then finally, your final piece of data is market signals. And I think at the end of the day, that is the most, the most quote unquote correct of, is, what are prices doing? What are calendar spreads doing? What is the shape of the curve doing? If you have, let's say an oversupplied model and you have inventory builds, at least observably, but then you have, deeply, deeply backwardated kind of calendar spreads, or a deeply inverted curve, or I guess downward sloping for backwardation, that also gives you a signal of like, wow, this doesn't always line up. So I think what my method and my kind of approach to this is, to take all of those pieces at the same time and try and make sense of them. And I think the reason, just coming back and defending the supply and demand balance kind of estimates, is I think what people often do is they will just project forward from wherever they're standing right now, but they generally do not know where they are standing right now. And I know this because I don't know exactly where we're standing right now, and I spend copious hours every day trying to figure it out. And I think that, if you look back at November and you say, like, this is where Chinese demand was, this is where OPEC supply was, this is where shale was producing, et cetera, it provides you kind of the most recent, reliable kind of like flag in the sand of where these major components of the supply-demand balance are. And I think if you assume that, like, in the intervening months, the intervening period, you've had this massive change in balances, you need to figure out like which one of those segments shifted. Because I think that gives you a different approach. Like if it's, let's say, Brazilian production, let's say, dropped materially in 1 month. Well, that's not going to be a thing that continues on in the future going forward, that it's one facility that had a turnaround or whatever, and that's going to bounce back. So I think knowing the reasons for oversupply or undersupply on a lagged basis provides you insight and, again, parameterization of what kind of the major moving or risk variables are now and into the future.
Before we leave the supply and demand topic, I have one hypothesis I'd like you to confirm or deny it. Let's say there's a big dispersion in the supply and demand estimates from the various data vendors. Is there information baked in that? Is that an indicator of perhaps future volatility in the oil markets, or is it signal-less?
I think it's important. I think this is both true about kind of historical and forward-looking estimates from the. I think in your context, I think you're mostly talking about kind of forward-looking, kind of the forecasts of OPEC and IEA and EIA. But you can also get, like, Chinese demand is a great example here. All three of those agencies, none of them agree on what the level of Chinese demand was in Q4 of last year. Which is important because when we're talking about one of the major variables this year being, Chinese recovery and a return of Chinese demand, well, where you were in Q4 last year or last year in total matters a lot in terms of what the potential kind of nominal barrel upside is. So to your point of like, but I also think that like various analysts like these different kind of estimates more or less than others. So if you have big dispersions, and right now, as an example, you have OPEC seeing growing deficits into next year while EIA sees growing surpluses. I think that right there is, I think, a great example of like, well, they both can't be right. And in all likelihood, they're likely both to be wrong and kind of probably meet somewhere in the middle. That, in my opinion, is usually what happens. When you see big, OPEC is a great example, always assumes that like Q4 demand goes to the moon. Like every year, you see their models and these massive Q4 deficits that are implied are always because of this massive Q4 demand number. And I think that you can just start to see these like patterns repeat themselves in the data, and you just kind of start to like adjust for that. You're like, okay, well, that's, probably not.
But doesn't that point to seasonality, at least? And don't these agencies factor seasonality into their estimates, or?
They do I would say to varying degrees. I also think there's each of the models that underpins, IEA, EIA, and OPEC are all different as well. I think some of them are much more complex than others. Some of them are much more like headline, regional GDP equals this many barrels. Some are trying to build it up from like a jet fuel, diesel, like an actual like end use model. So they all have different approaches. I have the ones that I prefer. But I also think that like, as an example, like IEA is great, but it's paid. And I think it's, it's a reasonably steep paywall for people that are just casually interested in the sector. I really like the EIA's STIO report, or the short-term energy outlook, because it's free. It's easily accessible. They've got a great data explorer on their website, and they have a fantastic API that allows you to pull all this data in, like a tremendous amount of data, and each month you can pull from. So you can also see the changes in those forecasts. I think the other thing that's really interesting, I track the changes of all these major agency forecasts month to month. So you can see kind of the tenor of like supply growth assumptions or whatever change over time. I think that is also really interesting.
So there's kind of an analogy in the equities world where analysts make earnings forecasts and they usually undershoot because it's not in their best interest to make a bold bet, but the adjustments they make have potentially some content. Is that kind of what you're saying?
I think that's exactly it. I think that's a great parallel.
Good stuff. Now, jumping a little bit, I've watched a few of your podcasts, and in one of them you said that, technicals do matter in energy markets, but eventually there's a kind of a tethering of price to fundamentals ultimately. And so prices will never stray that far away from fundamental value. Is there any way to quantify that, or to at least expand upon that idea?
Yeah, so I think when you look at, when people are thinking about oil or like the price of oil, they're typically just thinking about Brent and WTI, almost always. Me in Canada, I have an overt fixation on Western Canadian Select, which is our main export grade. But what you can see is, all of these different, and there are hundreds of different kind of blends and export grades of crude globally, and all of them have what you call like physical differentials to these major benchmarks. So I think one of the things that is often levied against kind of the financial sector.
By differentials, you mean sweetness, lightness?
Yeah, so differential would be mostly referring to the price, and then the grades, you have different reasons for the differential. So as a great example, just to kind of, provide a little bit more, content or context on this point, Western Canadian Select is a heavy sour blend of crude, mixed with, it's diluted bitumen, shipped from Canada's oil sands. It has a high sulfur content. It has a high cut of, a high passive or natural cut of high sulfur fuel oil. But it's also trapped in Canada behind very frequently kind of insufficient pipeline infrastructure. So when you see differentials blow out on Western Canadian Select crude, it can blow out for one of two major reasons. It can either blow out because, and by blowout I mean, normally the differential is like $13, $15 a barrel under WTI at Cushing. In 2018, that blew to $50 a barrel under WTI. So massive value loss for Canadian producers. And that was due to insufficient pipeline and egress for, your inability to get it. So they were literally stranded barrels in Alberta that had to be discounted to such a huge extent to basically like cover like almost like literally putting on a truck and driving it south. Like that was how bad the differentials were. This year, however, we also saw a differential blow to more than like $30, $35 a barrel. But there was very little, to do with pipelines. It was mostly to do with these global quality issues. You had, hugely discounted value for high sulfur fuel oil. I believe the crack spread or the refining margin on high sulfur fuel oil was like negative $40 a barrel. And basically crudes that have a high natural cut of that need to reflect that value erosion in an end product.
I'm showing my ignorance here. I thought there was just basically one widely quoted crack spread. You're saying there are multiple crack spreads for multiple different oils.
So the most widely quoted the most widely quoted crack spread is known as the 3-2-1 crack. And that's basically, it's the essential residual value of 2 barrels of gasoline and 1 barrel of diesel, compared to 3 barrels of crude. And that is because, for particularly North American and US refiners, that's a lot of what they produce. Yeah. But, you have a crack spread effectively for each individual end use product. And I think each crude grade or stream has natural yields of these different products, given, let's say, a really simple refinery. And I think that gets worked back into the value of these crudes. So this year, in particular, it's been very bad for WCS because it's been really bad for high sulfur fuel oil and naphtha and a couple of these other end use products.
Which is a bit worrisome, though, because if I'm a refiner in Alberta and I hedge my risk by trading the crack spread on WTI, there's a huge mismatch there. There's a massive amount of basis risk.
Absolutely. And it's been a huge challenge. And I think a lot of the Canadian majors are vertically integrated to a large extent. So they try and capture that by essentially refining or upgrading the crude themselves. So Canada exports WCS as diluted bitumen, but it also exports, we also export synthetic crude. So that's essentially upgraded crude that brings it up to a higher level and essentially changes that chemical component.
Which brings me to the point, if price discrepancies are large for similar assets, similar commodities globally, should oil companies, in theory, be more profitable because they have the infrastructure to arbitrage some of these differences in a way that the average punter doesn't? In other words, they can move commodities around, they can sell them into different markets, they have the transportation capacity, they have the refining capacity, all of these things. Would that be something that an equity investor would consider if they're large, potentially arbitrageable opportunities in, let's say, oil? Then whoever trades in those or deals in that business on a large scale should have an edge. Is that a reasonable rule of thumb?
I think that's very true. And I think what you've seen is through weird markets like this, you've seen, the large integrateds perform very well. Now, each company has different exposure to that kind of different elements of that, crack spread or differential blowouts. The other ones that benefit hugely in moments like this are, the large commodity trading firms, Glencore, Trafigura, et cetera. They have a tremendous amount of information about this market from very granular. They own pipelines and they own refineries. So they'll know far more clearly, far more early than virtually anyone else in the market as to what's really going on. And they'll have a better view on that kind of granular level over time.
Why is it that we never see interviews of traders from Glencore or various grains companies?
I was literally just on another podcast and I suggested, so there's a really great book. I would say 2 really great books. The more recent one is The World for Sale by Javier Blas and Jack Farchi. They're both Bloomberg reporters, and it essentially covers the wild world of commodity trading. And that covers, oil predominantly, but all the other commodities as well. Grains and metals, et cetera. The other one my first introduction to this, there's a book called, The God of Oil or The King of Oil. I can't remember exactly which one it was.
King or God
King
of
Oil.
Okay.
And that is essentially a book about Mark Rich. And the legend of Mark Rich. And for those that aren't aware, both Glencore and Trafigura are the essential children.
He founded them, didn't he? Yeah.
So Mark Rich & Co. basically became Glencore, and Trafigura was a split off of that. Some of the traders left and created their own firm. But fascinating history. And what you can see for Mark in the King of Oil and the Mark Rich story. In many ways, these traders and Mark Rich himself really created the spot market for crude oil. That historically, crude oil and the prices you saw weren't real things. They were essentially accounting metrics that, Exxon or Chevron or whoever would produce oil and then trade it within their own company. And the prices were essentially for tax purposes. And it was all very cozy. You had the Seven Sisters, et cetera. It wasn't until you had these residual leftover barrels that were outside of that system that traders could eventually kind of create liquidity in these spot markets. And that's what created and facilitated the growth of these, of a much more vibrant ecosystem of price discovery for oil. And that's eventually what kind of got, the major integrateds lost control of that. And what you're seeing now with other commodities, like let's say like LNG, we're starting to see a gradual kind of move towards something similar. That historically there wasn't much spot price discovery in LNG because there was so little liquidity. There were huge, basically all the cargoes were long-term committed. But now that you've had such just massive build out in infrastructure globally, you just naturally have like residual cargoes that can begin to trade and create this like better, more informed view on what current spot dynamics are kind of telling you.
Very interesting. I think the original question was about the tethering of oil prices to fundamental value.
Yes, and I got away from that, and I apologize.
No, that's fine. I'm guessing that simply because they're real money or they're real users of oil. It's not like various other markets where it's not a consumable good. It's just a security or something. Maybe that's the reason for the fundamental dependence over the long term.
So I think I'll stress two things here. The first thing to kind of support this point is that the physical, people often talk in a lot of securities and oil in particular, like the market will look through this, right? This is a known factor. The market will look through it and address it. But that's, I think, a misnomer that at the end of the day, physical spot markets need to clear. So no matter what your view, if supply is 10 million barrels a day over demand, let's say in April of 2020, the price is going to go towards zero. It has to. And essentially, it doesn't, and I think the important thing here is not necessarily the flat price that needs to go to zero or to go to negative, but what you need to do is you need to dramatically widen the contango in the market in order to facilitate and pay for increasingly scarce inventory space. And I think in distressed markets like you saw in 2020 and 2016 before that, in February 2016, you essentially saw the emergence of super contango, which essentially is the structure where you have like the spot price is at a $20 discount to, let's say, crude for delivery a year from now. And in my mind, in moments of extreme crisis like that, that reflects to a degree the cost curve of inventory, storage costs, that essentially as more and more of the easy, cheap inventory, like normally we're talking like 20, 30 cents a month for inventory leasing. Like it's usually pretty cheap. So contango doesn't need to be that wide for someone to have a very attractive arbitrage where they can say, I'm going to store this, I'm going to insure it, I'm going to finance it. And as long as those costs are less than the contango, I'm literally printing money. That's how the commodity market clears in moments of oversupply. But in super contango, you've run out of all those easy opportunities for storage. So that's when you get these like super tanker trades where like a commodity trader or a major oil company will literally lease super tankers and store 1 or 2 million barrels of crude in a tanker and just float it off the coast for like 6 months.
And keep it out there.
Yeah. and it's floating storage. So that's definitely true. I think the other side of this, however, is that I think physical traders, so like often what you'll see, like if a market's just trending sideways, let's say for 2 months, 3 months, the price hasn't really moved at all, right? But you see widening differentials one way or the other at the physical level. Let's say Saudi crude keeps becoming more and more expensive relative to that benchmark, those kind of benchmarks that you see trading sideways. That is a sign, I believe, that the physical market's telling you that the financial market is underpricing these commodities relative to end users. But in moments like last year where you saw a very rapid rise and a lot of physical traders were saying, look, these differentials are not screaming kind of crisis levels. This price is running away. This is all speculation, et cetera. But even if, let's say, you were at like a weak kind of differential, or let's say a weak discount for these crudes, but that discount was staying relatively flat at that, weakish level, but oil gained $40 a barrel. That doesn't mean that the market's weak. It just means that the financial market was a couple weeks ahead of the physical market. And I think that's actually exactly the point of what financial markets are for. It's for allowing a huge amount of information to be transmitted into price discovery very quickly, often faster than the physical realities manifest, because this is all about forward-looking anticipation, et cetera, et cetera. So I think both of those things can be true, that you can have, real physical kind of signals and value. And I think it's always important to look at both sides of this. But I think that both can kind of tug and pull at different moments in different ways.
Yeah, I mean, I've always sort of thought of things from the leverage standpoint in the sense that, say, a trend follower, why do markets trend? They trend because if you have a position on and it's on side, the market's moving in your direction, you have more margin to play with, so you can build your position even more. And so markets overshoot as a function of the growth in speculative profits in the direction of the move. I didn't phrase it that well, but what you're saying is that there is an underpinning here that sort of eventually will overwhelm the speculative stuff that's going on.
Exactly.
So
and I think,
is the upshot that if I do look at commitment of traders reports and things, and if I do figure out how to understand them and figure out who's a spec and who's a hedger and so on, it might help me, but only over a shorter term horizon?
I believe that's
what you're saying.
Yes, I believe that's true. I think that, so like in my weekly, Oil Context Weekly, I cover kind of 5 main things every single week, one of which is the Commitments of Traders Report. And the reason I see it as valuable, and to your point about kind of hedgers and kind of spec and non-spec, I typically just use the disaggregated numbers and use the managed money component, which I find to be the most volatile and I think like the most capricious in this way. And I think the reason that, to your point, I see it as useful. I don't think it's necessarily useful for forecasting, but I think it's useful for like tactical risk management. That if you see
positioning, over positioning.
Yeah, exactly. And I look at it both in terms of nominal barrels and in terms of like as a share of total open interest in the contracts. So as an example, back in, November or back in, even very recently, you saw spec interest in these contracts reach very high levels of total open interest relative to its recent history. And I always kind of normalize it to, let's say, like the last year of whatever the norm is. And I think you see deviations, but it tends to mean revert. And I think I always think about spec in this capacity as like the most flighty, the most capricious holders of this crude that are holding it for entirely non-commercial reasons. So if they're really, really bullish, they could get slightly more bullish. It's not likely that they get materially more bullish from there. The next most likely outcome is that they mean revert. They take profits, they sell back down. Someone gets spooked and they start establishing new shorts or whatever. And I think that's actually what we've seen.
I hate to speak like an academic here, but you're saying when the final marginal buyer has been tapped out.
Absolutely. And that's what I view them at. I view them as marginal buyers. And I think that's the exact perfect word for this, that you have the normal structural price formation that's going on in the market. And then these players kind of get on and they can either just take flat price exposure, or they can take like steepener or kind of flattening trades in the curve, et cetera, et cetera. But I think to your point that like, if your marginal buyers are really overextended, it's not likely that you're going to have much incremental marginal buying. But if your marginal buyers are really, really short, you have a lot of dry powder on the side of the market that is typically associated with oil investments. So I think, you see that typically come back in. I think that's a fairly reliable kind of metric. And I think it's not causal, but I think if you have a really high net spec as a percentage of OI, you have a higher risk of these major kind of downside moves. And I think when you're really, really short, you have a risk of these major upside moves. And I think that's kind of how I approach the COT report.
That makes a lot of sense. Next question is, oil is priced in dollars generally in global markets. So isn't the oil price really just a play on the dollar?
It definitely can
True or
be.
untrue?
I think like if you look at it like on a one of the charts I have on my like on the Bloomberg kind of terminal up to the side of me here is, you know, basically just Brent and then an inverted DXY. And I think it provides you a good sniff test of like if crude spiked one direction and the dollar spiked in the other direction, you can say, okay, that might be because of like, you know, a risk trade that, you know, people are flighting to the dollar. And I think that's the important thing. You have both denomination effects and you have kind of inverted kind of risk off, risk on trajectories as well. That, you know, when people flood into the dollar, it's often because they're, you know, worried about growth or whatever. And then at the same time, people will de-risk oil. So I think that's a good way of like just sanity checking yourself.
So if I go to March 2020, let's say the dollar rallied hard, oil dropped hard, even harder. How do I know what percentage of that or what the loading was on the dollar vis-a-vis just a collapse in demand?
Yeah, so I would say I wrote a piece on this actually. You know, I called it "Dollar Wrecking Barrel," which I thought was a fun play on that.
Very nice.
And it was essentially about this. So this whole thing that we've been talking about, typically they move inversely, you know, inverted to one another. But for the majority of 2022, the dollar rallied at the same time that oil was rallying. And I think what you saw in that moment was this concern and flight to kind of quality, flight to dollars, because of a ground war in Europe that also had a major oil element. So I think at certain moments they can trend together, you know, positively correlated when the risk is something specifically related to the oil market. But to your question about like, can you extract like these specific denomination effects? I've tried in a couple different ways. I think the most effective way of doing it, or the most kind of I was going to say theoretically, but I almost said theologically sound, is essentially the way this is really going to manifest at the end of the day is affordability of oil and oil products. That the majority of the world that consumes oil does not earn money in dollars, but the commodity is priced in dollars. So when you see, let's say, a major devaluation relative of the renminbi or the euro or whatever, it's proportionally more expensive for those consumers to consume oil. So you'd assume that all else equal, oil would adjust gradually around that. And I essentially create like a consumption weighted currency index. And you can kind of, extract how much of that was based on denomination effects alone versus flows effects. And I think both of those can play in. That said, I think, very frankly, I think the denomination effect on a kind of let's say a months long time frame, I think is a useful framing. But I think day to day, it's probably not that useful. I think it's probably an overcomplication of a relationship that like dollar goes up, oil goes down.
Yeah, I was going to come to that. So if I picked a horizon, let's say a month, and I break the scenarios up into 4, oil up, dollar down, oil down, dollar up, and both down. That where you are, which quadrant you're in, should tell you something about the state of the world. Is that a fair, at least on a retrospective basis?
Yeah, I definitely think that's fair. And I think that like if you let's say in like a month or even given a week that like let's say so like oil prices rose by $10 and DXY was up 5%. Then yeah, it's actually an even better week for crude because on a dollar adjusted basis, crude's done even better. So I think, that I think I'm going to keep coming back to context. I think it's important to kind of ground yourself in why you think these things are happening together. Because I think that informs a bit of your view of like, well, is that going to persist? Is some of this going to unwind? Which side is going to unwind? I think it just gives you a bit of like tactical awareness of the space. I think a lot of people just passively kind of consume this data. And I think it's always important to kind of critically kind of assess why those things are happening together.
Now, let me throw another monkey wrench in the works here, which is that if I understand correctly, the Fed model for inflation uses oil as a major input. It assumes that perhaps oil prices are transitory or highly mean reverting, but if they become sticky, suddenly all bets are off, sticky and high, and you can expect, at least if they follow the model, tightening. So is there this complex interaction between short rates, oil price levels and stickiness, and the dollar? Is this some kind of strange brew that one has to consider? Do you consider that stuff, or is it slightly outside of your boundary? let's say?
I definitely think, particularly in moments like this, like no one can ignore monetary policy. I would not consider myself like a well-vetted Fed watcher, but I think what we interestingly saw last year, and I think historically you've seen the Fed kind of really focus on like these, core inflation drivers, kind of structural moves, in prices, and would, I think, in some ways actually fade to just like temporary energy or food effects. But what you saw a lot of commentary around last year was this overwhelming concern with headline inflation and this idea and this risk of an unmooring of consumer inflation expectations. And I think for that reason, you saw Fed officials, continually cite not just oil, but specifically pump prices. And the other thing that was going on last year and why everyone was, I think, particularly losing their mind over gas prices was not only did you have oil at 120, you had gasoline crack spreads, which normally are at about $15 a barrel. Gasoline crack spreads were at $60+ a barrel. So you weren't paying $120 at the pump. You were paying $180. And I think it was that double whammy. So the Fed became overly fascinated and overly fixated on oil prices. And I do think for a little while there, at least, when prices were that high, they were going to keep hiking until prices came down. Now, thankfully, they did come down. So that wasn't the kind of driving thrust anymore. But I do think that, and I say this often, like, now you hear there's an egg crisis stateside, right? Like, these, all of these prices and whatever, skyrocketing. But I still guarantee you that people are not as aware of the price of eggs as they are the price of gas, because it's literally the only thing. And it's literally everywhere. You see the price everywhere. So I think if you're the Fed and you're concerned, and I think there are legitimate debates over the kind of usefulness of inflation expectations in kind of inflation modeling. But we know that the Fed takes that very, very seriously. And if your concern is an unmooring of inflation expectations and you're worried about what consumers are seeing and kind of feeling, then yeah, gas prices are going to be literally top of that list. So I think, for them, both oil prices came down by 40% or so from that level, but thankfully gasoline crack spreads went from $60 a barrel to almost flat, almost zero in the U.S. and I think negative in some areas of the world by later that year. So I think that helped take a huge amount of pressure off of kind of monetary policy authorities and this kind of concern of inflation expectations.
Now, speaking of spreads, I would have thought naively that oil and natural gas should have some relationship because drillers have a choice, at least to some extent, what they're going to drill for. And why has nat gas gotten hit so hard relative to oil? Other than the oil sands argument, the structural argument, is there anything else behind all of this?
My one caveat here is I do not cover nat gas nearly as closely as I do crude markets and refined product markets. But I think as an overarching thesis here, I think there's two things that you should consider at once. One, the North American gas market is very, very structurally different from the rest of the world's gas market, a natural gas market, I should say. In a lot of areas of the world, and this is true for a lot of LNG shippers and even like pipe gas from Russia, is a lot of that was actually explicitly indexed to oil prices because in many cases, producers were actually typically not targeting gas specifically. They were actually targeting oil, at least historically. What you see in North America is much more of a decoupling of those markets and a lot more kind of gas on gas competition in terms of pricing. So I think in North America, you've seen that they have fallen, I think, similarly over the last, let's say over the past 6 months. It's been a kind of a bad 6 month period for both crude and natural gas. But I think that the way I think about it is not so much in terms of like demand competition, because there isn't much. Like there aren't many moments where you actually have a lot of substitutability between oil and natural gas. But at the producer level, I actually think that, when people always talk about like break evens or like the cost of production for a US producer, they talk about it in oil terms. So like it's a $60 break even or a $70 break even or whatever. But the important thing to remember is that many of these producers produce like a 50-50 gas oil split. So the higher the price of gas, steady state assumption, the lower your effective break even for oil is. So what we've seen now when the price went from nearly $10 a million BTU for Henry Hub down to we are currently at $2.63 as I'm looking on the screen right now, which is not a great price for gas, let me tell you. But that kind of 75% reduction in the value of gas inflates, all else equal, the break-even price of oil that these producers need in order to actually have profitable oil production. So that's the main way I look at it, is I look at gas and how it affects the oil market. The other thing that you see is that natural gas is a very material input, both for heat, power, and for the production of hydrogen in refineries. So what you see as well, and one of the reasons that you saw quality differentials, I was talking about this earlier with heavy blends of crude, et cetera, when the quality differentials blew out, they often require hydrogen to kind of continually break down into more and more valuable products. And if your cost of hydrogen, because of the cost of natural gas, is skyrocketed, either it's because it's like $10 Henry Hub or, truly astronomical levels in Europe, well, that's completely eroding your refining margins. So when you look at the crack spreads are a screen, a simple product on product, but they're not taking into account the underlying refining costs, which have also exploded. So that's why that challenge also comes in, particularly for, an area like Europe that had astronomical gas prices and astronomical power prices, and refineries are both gas and power highly intensive. So that also erode those crack spreads. So those effective refining margins. So that's a challenge that sometimes the crack spread on the screen will tell you one thing, but the reality on the ground is very different because maybe there's a reason that those crack spreads have blown out to that degree.
Fertilizer. Isn't nat gas relevant for fertilizer production?
Yeah, absolutely.
Is there a disconnect between farming pressures structurally and nat gas prices in your view? Or is it something that there's so many different factors one can hardly isolate one? I'm
not an agriculture market kind of expert by any means. I do think that it obviously hurts, hurts profits. I think you saw a lot of that both in 2021 and 2022. What year are we in now? So I think that was a topic of discussion. But the other thing I think in many ways that's hurt farmers, as much, if not more in some cases, is while I mentioned gasoline crack spreads were at $60 and came back down to basically zero, diesel crack spreads, which is the main kind of fuel that underpins farm equipment, kind of industrial machinery writ large, those crack spreads, they're actually down materially. And right now in New York Harbor, they're sitting at about $45 a barrel. That hit almost $70 a barrel, which again, normal $15. So these are huge kind of cost burdens for producers that, consume diesel in large quantities. I said earlier that I think one of the best personal trades I've ever made was in 2021. We switched a diesel car for a gasoline car, not based on any personal kind of professional view, just because that was what available with what we were looking at. But it ended up being one of the best trades I've ever made because, oh my gosh, the diesel prices have been painful.
Very interesting. Now, I'm worried because we've gone over an hour, and I don't know what Niels is going to say, but I'm going to say we should do a round 2 one of these days as well, if you're available.
Always happy to join.
But is there anything you'd like to say in conclusion? I know we've covered a bunch of topics. I didn't make as many contentious statements as I'd hoped, but we can always do that next time.
I'm sorry.
Is there anything you'd like to
as always.
No, it's not it's more me. But is there anything you want to tell the audience about what they can look for from you going forward, or what you're focused on now on the research side?
Yeah, so on the research side right now, so I was mentioning, obviously, a lot of my focus has been on the supply-demand, kind of this lagged model. The big thing I'm working on right now is essentially nowcasting that model. So bringing that from 2 months lagged to as close to present as I possibly can get. And then from there, I'm looking to actually begin forecasting. I don't actually have official forecasts right now because I think my value add is more on this kind of decompositional historical work. But
is
right
it
now
nowcasting statistical work, or is it?
It's partially statistical, partially kind of alternative data. So right now I'm working on jet fuel and kind of using a variety of the different data providers out there that provide real-time kind of flight activity and trying to kind of relate that to jet fuel demand. And I think that goes in, and then from there it goes on to, fuel oil and shipping demand. And then you go into, gasoline and diesel work, et cetera. And I think that's going to be my way of beginning to kind of work that through.
Excellent. Well, I look forward to that bit. I mean, that's long overdue. I've seen inflation and GDP nowcasts, but I haven't seen an energy one. So with that, I will hand it back to Niels.
Thank you so much, Harry and Rory, for a conversation full of energy and some really good insights. There were quite a few things that really stood out to me in this conversation, and I just want to mention a few and probably do it in reverse order. And I think the impact of nat gas on the refining industry was quite fascinating, as well as Rory's comments to the relationship between oil and the US dollar and how changes in correlation can tell us something about how the world is doing. Also, I really appreciated Rory's reminding us of the price discovery process within commodities and how that can lead to some unimaginable price moves like what we saw in oil in May of 2020. Of course, Rory's book recommendations were great, and I think both books are in my ultimate guide to the best investment books that you can grab a free copy of on the TTU website. And I'm sure you can tell that we believe that energy and commodities in general are super important and critical to understand, and we will do our very best to bring you more great content in this area of finance. Make sure you go and follow Rory's and Harry's work because, as you can tell from today's conversation, there are many exciting facets to learn from those who have been in the trenches for many years, and we really look forward to exploring many more of them as our series continue. From Harry and me, thanks so much for listening, and we look forward to being back with you on the next episode. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.